by Chris, who will be putting himself forward to answer those questions as they come forward, as well as some early ones that we had received by way of email. So I'll just sign off now, and I'll pass you over to Chris, and he will take it forward. Thank you very much.
All right, thanks, Steve, and I'll get straight into it and share my screen. Okay, let's just see if I can do this. All right, so now hopefully you are seeing a picture of me in a spacesuit as I venture out into the world of COVID-19. Steve, if you can just confirm that that's come up all right, and I'll get going. Okay, that's sounding like good. Right, so without further ado, my name's Chris Tennent-Brown, and as Steve said, I'm a senior economist at ASB. That basically means I've been doing this for a long time. I've been an economist at either ASB or our parent bank, Commonwealth Bank, over in Australia since the early 2000s, and prior to that, in the 90s, I worked in the funds management industry for a firm called Bankers Trust. So I've been around a bit. I've been through a few challenging times: the Asian crisis, the global financial crisis, the terror attacks, Y2K, and every crisis is a bit different, and this one certainly is. But there's some similarities as well. So we'll go through and just try and make heads or tails of how we think the economy is going to track and perform, and hopefully answer some of your questions. Thanks for the ones that were sent through in advance. And one of the first ones is a great question. As we come out of level 1 lockdown, what are some of the immediate impacts that you expect based on what we learned in prior lockdowns? So here's a good place to start. As an economics team, we're putting out a chart pack every week showing as up-to-date stats as we can possibly get to see how we're tracking. And the first thing I get when I look at things like these mobility data from Google, the Oxford Response Index, is we see what we all know and feel is that our lockdown was pretty hard compared to everyone else's. But now we're reaping the benefit when we come out the other side. If you look at the chart on the bottom left of mobility, we can see that we were not moving around a lot in March and April, way more restricted than the other countries I've shown there. But by July, we were the most mobile. Then we went back into our strict lockdown. We learned a bit in that lockdown, and alert level 3 certainly got a lot more activity than level 4. And now here we are out the other side, and that was taken last week before we moved into alert level 1, where we're back at being more mobile than those other places. So I actually think that's a pretty good outcome. That we've seen a good result in terms of health outcomes, but we're actually seeing it in terms of mobility, which will lead on to economic outcomes. Now, you'll guess from my presentation that I've called the 95% economy. This doesn't mean we're back to normal. We can see that there's still less mobility than there was prior to all of this happening, and the missing link is clearly international visitors, and that includes tourists, but also international students, and that's going to be a break on us for a while. And of course, the Prime Minister has warned us. We need to expect more cases of COVID. Perhaps we'll go into lockdowns again, but we can see that when we do go hard and go early, to use the catchphrase, if it works when we come out the other side, we can move around a lot more than elsewhere, and I think it's worth remembering that. If we aggregate it all up, what we see is other places have had a less severe drop in their GDP. If we look at our trading partners, we had that pretty big contraction in the second quarter. The economy was down about 12%, which in anyone's books is a massive drop. But the flip side of that is that we will come back stronger than other economies, and look at Victoria's economy as a case in point. Less of a contraction in second quarter GDP than what we had. But I would imagine that their third quarter GDP, with them in very strict lockdown at the moment, is going to be way worse than our outcome. So we won't actually know what was best, what did the most economic damage for many years. And I'm sure there'll be plenty of studies done on it. But around the world, we are seeing these V-shaped recoveries in the first instance. The question is, do some of these economies go back into a dip afterwards? To put these contractions into perspective, they're very short and sharp, but they are way worse both here and abroad than what we saw in the global financial crisis in terms of the overall impact. In the global financial crisis, the economy kept on shrinking for a year, but not by as much as it shrunk just in the one quarter. And we think by the end of this year, the economy will still be about 3 to 5% smaller than what it was at the end of last year. So a pretty challenging environment, even though we're doing pretty well at the moment. There's I'm sure I'm not the only one that's heard the saying, the sequel's never as good as the first time round, and I think a lot of people found the second lockdown pretty tough. And we thought the loss of activity was about 440 million per week. One of the things that has been a good surprise to us, though, is that none of the actual outcomes when the data is coming in is quite as bad as what we worried about back in March. I think we've got pretty good at working out how to get some activity taking place. Level 3, where builders can carry on working, certainly makes a big difference to employment. And of course, level 1 is the place where we want to be. So it's pleasing that these stats that we came up with to try and predict what sort of damage was taking place are proving at this early stage to be on the conservative side of things, and the economy on the whole has been coming back better than what we expected. Confidence has been reasonable. And there's things like the housing market that we thought would be in a pretty major hole by now that is actually looking like it's going to go pretty well. And this leads into another question that we've been asked, is from a perspective of the political response, the Reserve Bank response. How do we rate it? And I rate it pretty highly, actually. I think what the Reserve Bank did by slashing the cash rate down to 0.25% in March, stepping into the bond market, providing a huge amount of liquidity, is exactly what was needed. And the government's policies were the right thing to do. And actually, if we compare our response to other governments, Australia and the States in particular, we've got money out into the economy pretty quickly. There's been a lot of stuff that in all economies has had to be made up as we're going along. There's going to be some misguided spending, some poor projects whenever you're acting quickly like this. We saw the same in the global financial crisis. But on the whole, I think the process has been pretty reasonable, and that's why we're getting these better economic outcomes than what we thought. The challenge, of course, lies in how to get out of it. Now, there's our GDP forecast versus our trading partners, just blown up a little bit, so you can see that our contraction is a little bit bigger than elsewhere. One of the things that's hard to avoid is what this is doing to migration. Now, in the first instance, missing tourists are a key factor, and the service sector are going to keep doing it tough with missing people. Places like Queenstown have more of their income coming from tourists than elsewhere, and these missing people are clearly an issue there. But we're also going to see this as an impact on beyond that demand impact. We're going to see this in the labour market. If you look at things like the kiwi fruit industry, fruit picking in general, a decent chunk of their labour force, 0.25% or more, come from overseas. Hospitality in a number of areas really relies on people coming here on their working visas for a year and working. So it's going to be challenging finding labour, and in some cases firms might need to pay more to attract a Kiwi to do it compared to someone that's backpacking around. That's not because the Kiwis are snobby or anything, but have a look at some of the accommodation issues that things like the kiwi fruit industry have been grappling with, and you'll see what I'm hinting at there. Likewise, I lived in Queenstown for a year, and it was not an uncommon sight to see the people that were perhaps serving you in the bar or helping you onto a chairlift sleeping in a car because they weren't making enough to pay the $200 or $300 per week for a room out of the salaries they got. So there's going to be some really interesting impact from the lack of migration coming through from a demand perspective within the economy, but also for the labour market. One of the other things which this has an impact on is if we look at New Zealand's economic growth, the overall economic growth story has been pretty reasonable. But when we do per capita GDP growth, it's always been weaker, as we can see in this chart. So this is the amount of economic growth generated per person. What's another way of looking at a chart like this is one of the key sources of growth within the economy has simply been the population growing. It's telling you some things about productivity as well, but this is also telling us that as long as we don't have more people coming in driving population growth, it's going to be a bit restricted on the economic growth that we can expect. This isn't because the current government's doing anything wrong. This is something that you can see has actually been going on for a long time. And productivity growth has been talked about for a very long time. In some ways, this is the little secret of governments. They like a little bit of inflation. Government's always in debt. Inflation makes it go away. They love a bit of population growth because it keeps the economy rolling. But obviously, this creates some issues in other parts of the economy, like accommodation shortages, etc. So that's clearly an area of risk in the economy as long as we have extremely restricted travel. And so one of the government's jobs is to fill the potholes. And you can see things like this wage subsidy extension, business support package. A lot of this will go into tourism businesses. The important thing, I think, is the transition out of some of those jobs and out of some of those subsidies. I'll use my partner as an example. She works for Qantas. Qantas itself has told them that they won't be flying for all of this year and through next year. They're still getting a wage subsidy. Some people that work for Qantas in Australia are getting a wage subsidy up until March next year. And ultimately the government's paying for that. So the transition out of that, if it's unrealistic that those jobs are going to come back, and into other things is really important. So the trades and apprenticeship training packages, those sorts of things are really important. the environmental jobs package that we saw, I think of this along the lines of John Key's New Zealand Cycleway project, that some of these things are about putting jobs into areas where you just need some work taking place. They're good because a lot of these areas, think Otago, the South Island, the West Coast, they're going to get hit hard with the tourists not being here, and there's plenty of environmental work that can be done there. So these are subsidies and spending in areas of the economy that will need it, as well as being nice to haves as well. There'll be some other things going on in there. I'm sure there'll be plenty of stories over the next year or two of some of the misguided projects that take place over this period. But as I mentioned earlier, in a crisis, one of the keys is to act quickly. When you do that, there'll be mistakes that get made. Incidentally, when these packages started to get rolled out, this was from the budget in May, but when the government here and abroad started talking about the size of the spending that they expected to do in late March, early April, that was when we saw share markets start to recover, essentially as investors endorsed the size of the spending that the governments here and abroad were proposing. And as we can see in the States now, that can carry on for a while. New Zealand doesn't have that degree of difficulty because they approved so much unallocated spending within the budget back in May. So it's certainly simpler for us to roll out these sorts of projects here than it is overseas. Hand in hand with that, though, is huge debt. The logical question is, can we afford it? We were running a surplus up until 6 months ago, and so the government was able to retire bonds, and now we're running these monstrous deficits, and government bond issuance has just gone through the roof. Back at the update in 2019, the government was talking about issuing $10 billion worth of bonds per year and getting smaller. Essentially, this was just replacing bonds that matured and taking some of them out of circulation. Now, this year, they're issuing $60 billion worth of bonds. And so who buys all that? Well, one of the answers is the Reserve Bank's buying a lot of those bonds. And the Reserve Bank's bond purchases have meant that the government's interest rate will remain very low. The yield on existing bonds in circulation is down to 0. It's traded with a negative yield at some stage, which is something tricky to get your head around. So this is manageable, and at the end of it all, the government's net debt relative to the size of the economy will be about 50 to 55%, which is a lot by our standards. It was 20% going into this, and it was even lower prior to the global financial crisis and the Canterbury earthquake, but we'd got down to 20% of GDP. This is a very small amount of government debt, and we're going up to 50, 55%. Now, places like the UK, Japan, the US were at a higher level than that when they started the crisis. The States is over 100%, so this is pretty manageable. What's a pity, though, is we all know that successive governments from the late 80s onwards were really trying to wind in government debt. There was underinvestment in some areas of the economy. We get it all the way down to this very admirable and prudent level of debt, and then we have blown it right back out to what it was in at the start of that 20 to 30 year period in a matter of months. So it's a big pity. It's an amazing transfer of debt from one generation to the next. But it's what's going on around the world, and required to avoid something like a Great Depression style level of unemployment. one of the bits I keep coming back to tourism because they're the missing parts of the economy. We hear a lot about New Zealanders needing to do their bit, which is true. But one of the things we see looking at this chart here is that New Zealanders already do an awful lot of travel. Auckland is, there's only areas like Auckland and Queenstown where international tourists outnumber domestic tourists. So there's only so much that we can actually do, and gee, there's a lot of pent-up demand, and we can see that by how quickly we've started traveling as we've come out of each lockdown. And so this will be good for the regions, but it's not a magical fill-in because we already are traveling quite a bit. But hopefully we'll spread the places that we travel. Queenstown's on everyone's list, but there's other areas which are pretty awesome as well. You know, the East Cape, the West Coast of the South Island, all of these places will hopefully be able to attract some more domestic spending. One of the things which is hard from a business perspective is we see the spending taking place. You could go to somewhere like Queenstown and it's extremely busy in school holidays, extremely busy in the weekend. But in the week, we're all getting back to work, and whereas your typical tourists would be here all through that time. So some of this domestic travel is very well received, but it is patchy compared to the steady stream of international travellers that these operations are used to. We can see within our electronic spending data, so this is credit card spending, the areas that really dropped off in the lockdown. Hospitality really suffered, and then it's bounced back as we've come out of it. But you can see from this chart here through August and into early September, we still weren't back at 100% for a lot of categories. The area that went really well, that performed better than it normally does, is consumption. So think supermarkets and durable goods. Seems a lot of people have decided to buy an oven, buy a new car, renovate the kitchen, do something, but expenditure on durables, so things that last longer than a couple of years, has really taken off as we come out of the lockdown. One of the things in the car market, car prices dropped as we got flooded with rentals, and so that really stimulated some activity. So this is the strong bounce back that we're getting in the as we come out of lockdown, that some other parts of the world won't be enjoying as they go back into lockdown. And clearly, this weekend will be a big one for hospitality in Auckland. First time we're allowed out unrestricted. Although what we saw in this lockdown was a pretty reasonable level of service was still able to be provided once we got to alert level 2. Beneficiary of this slightly better than expected performance, we ran these scenarios for what we thought the unemployment rate would do. Clearly, it hasn't spiked like we worried about. There's a little bit of a falseness in the second quarter's data. There are a lot of people that, from a working perspective, were unemployed, but from a technical perspective, they weren't because they were still getting paid by their employer, courtesy of the government support package that was flowing into their business. But the fact that we're back at alert level 1 across the country now as we go into the fourth quarter means that the unemployment rate is now looking like our upside scenario. So getting up to around 6% from 4%, but not up to the 10% or more that we fretted about early on. So that's a really good outcome. But there's going to be businesses that are idling, not operating at full capacity. There's going to be some people that realistically are unemployed, but they're still on the payroll. Thinking of my partner here as an example with Qantas. But look at the CBD of Auckland as an example of where people will be operating below capacity. Even though they might still be employed, they're probably going to be underemployed for a little while. But all up a better situation than what we worried about. The the next bit on this is, okay, so we can see what the government's doing, and I'll finish here with what's the Reserve Bank doing. Well, the Reserve Bank's still going to do more. We think that they'll probably cut the cash rate into negative territory if the economy gets any weaker or hits any more soft patches. We're looking to the Reserve Bank over the coming months to put in place a funding program to allow banks to access cheaper funding for longer terms. The official cash rate's at 0.25%, but we can't fund a bank using an overnight rate. So we're looking for facilities like we see in Australia, where banks can fund for 3 years at the Reserve Bank of Australia's official cash rate. So that's the type of thing we expect to see here over the coming months. What that means for mortgage rates is that they're likely to dip further. We're seeing them just slowly getting chipped away around about 2.5% now. And off the back of that, a much better housing market outcome than we expected at the back in March, where we thought house prices could be very, very soft by now. So all up, a much better and quicker pickup than we expected, but we're still missing that 3 to 5% of GDP through the border closure. We're still vulnerable to more outbreaks, as we've seen in the last few months. And some big question marks about when and how do we open the border? What's the master plan for the economy? If that border opening is hard, if we get more outbreaks, and what do we do with those jobs that are really on life support at the moment? So I'll stop there and hand back to Steve. And tackle any questions that we've got if we have time. I'll have a look here and see if I can see any that have come through. Okay, a common question that asks is, who will pay for the government's response package? Well, I guess at the moment the Reserve Bank's effectively absorbing it, but ultimately there is a generational cost. The debt that's there and the interest that needs to be paid on it is a constraint in for future government expenditure. So there is a cost of all of this, even though the Reserve Bank is effectively buying the debt. Another question said, do we have concerns about supply chain bottlenecks? Absolutely. Export levels here are looking really good relative to what we thought about. Import levels have been down, largely because we're consuming less. But there's some real issues of constraints coming in. Just global shipping has been severely disrupted. A lot of our freight, about 50% of air freight, comes in the bellies of passenger planes that aren't flying. So air freight's been severely disrupted, and shipping there's not as many routes as there have been in the past. So that's really constrained as well. If you're exposed to logistics, reading logistics reports from suppliers, to me, has been one of the most interesting things to get a handle on that. Finally, with Mark's asked, do we still see the drop in house prices in 2021? Not at the rate that we're going at the moment. I think this will. I think what we're about to see is things really pick up and spring off the back of these low mortgages. So unless we get a hit to the labour market, I think the soft patch for housing is probably over. And we can't rule out a further weakness in the labour market, but it's panning out on the good side of expectations at this stage. Okay, I'll hand back to Steve and see if he's got any other questions.
Thank you, Chris. You preempted one of my questions in relation to a softening labour market, insofar as not so much unemployment, but potentially underemployment, so people not having necessarily the spend to be able to meet their mortgage obligations. You've kind of covered it off. But would you say that that ASB is seeing a qualified positivity in the economy?
Yeah, I think we are. There's concern There's definitely a caution from businesses about investing, which is understandable, and there's excess capacity in the economy, which is going to contribute to that under investment. I mean, for example, think of something like hospitality. It's easy to see how there's a lot of excess capacity in hospitality. And so that's an area where we won't see as much investment as we would have. But generally speaking, we're seeing really good outcomes. One of the interesting things, and this is more of an internal measure we look at, is the health of people's accounts. And over the lockdown, people's accounts have actually got healthier because their income's held up in many instances, and expenditure has dropped off. So now, if anything, some of that turns into pent-up demand. And then that folds into that earlier point I made about durable expenditure actually starting to pick up off the back of it. So it's a pleasing mix. Doug has asked, is the lift in house prices actually a good thing for the economy? This is that age-old thing. It's good for confidence for people that own homes, but it's terrible for housing affordability. And to me, it's not a good thing for us to be going, hey, look, here's our solution. Let's just borrow more money, buy housing, and keep the economy going by more and more expensive housing. So it's a sign that individuals are confident when houses go up. It's an inevitable response to lower interest rates. But obviously what we want to see driving things is businesses hiring and investing. Rather than just the housing market and consumption related to that. So to answer probably what I think you're alluding to, Doug, I'm not happy that and don't see as a success that we've just got cheap interest rates and more expensive housing. I think we need to see a bit more quality than that.
Kevin Mackay asked the question, why wouldn't the Reserve Bank just write off the bond purchases?
Yeah, it's a good question, and if you feel like your economic textbooks that you had at university say something different to what's going on, you're right. I threw mine out a couple of months ago, and it will be very, very interesting to see what governments do with all of this debt that's now sitting on central bank balance sheets. Of course, the fear if you just wrote it off and said we're never going to pay it back is you'd find it very hard to issue more debt into in the future. But it does become a little bit of Never Never Land, doesn't it, when the central bank owns it and the central bank has indemnity against losses on the government bonds from the government. This is the sort of backdoor way of writing it off, is when the Reserve Bank just doesn't make any money and pay the government a dividend because they're losing money on all these bonds that they bought as they slowly wind them off the books at higher interest rates than what they bought them for. So it's going to be messy. And actually, if you're interested in this stuff, look out for an article that Alan Bollard, the former Reserve Bank governor, wrote in the newspapers this week. It's definitely worth having a read. He comments on some of these things.
Well, that'd be good. Actually, Chris, there was the old elephant in the room in the United States, and someone's asked here, if Donald was to get another term, would there be concern in relation to volatility around the USD?
Yeah, what tends to happen with the US dollar is it's a counter-cyclical currency. So when the world's worried about global growth, even when the concerns come from the US dollar tends to strengthen. The logic being that if the States is falling into a big hole, then it will drag the rest of the world into it via a lower overall economic growth and lower demand. What I think we're probably going to see is plenty of volatility running into the US election. We've already seen it this week. Trump said yesterday to his Republicans, move away, do not negotiate. Then today he's out urging them to negotiate. Markets dumped 2% yesterday. They got it back today. It's just crazy. And so I think we'll probably get a little bit more volatility coming out of that, and I just hope we have a more benign political outlook for the US over the next 4 years, which realistically means I'd be supporting pretty much anyone apart from Trump at the moment. But each to their own. But it's been a crazy 4 years.
We have one last question here from Darren Ward. Thinking longer term, how important will it be that focus on sectors that can lift productivity, and what should this mean for government stimulus and investment now?
Yeah, that's a good question. Look, I think one of the things which shines through at times like this is the agricultural sector just ticks along. They've been feeling pretty unloved for the last few years with some of the restrictions and challenges that have been put on them. I think this is a good chance for the government is going to be running big deficits. The government can do some of that spending. So some of these environmental packages and plans to clean up waterways and things like that can create employment. Perhaps this is a chance for the government to do more of the lifting on that than what they'd planned, and take a little bit of the strain off the primary sector. There's initiatives like which I'm quite pleased to see what looks like a more practical winding down of TY Point than a sudden closure. Would be good to put the infrastructure in place so that things like Fonterra can get off the coal and get onto electricity at some of their plants. So there's a lot of things that we can do, given that we're going to be running deficits, to make the traditional sectors go well. The big unknown for me is what's the plan if we don't get a vaccine and we don't have a smooth opening to borders over the next year or two. How does the government transition out of an economy that's tourism's our biggest export sector? And how do we reinvent that? I think the other thing that I'd like to see that I think is a help with productivity and a help with government expenditure is continued push for digitalisation. We learned a lot from working from home, and it's a good chance to relieve a massive need for infrastructure if we keep doing that. But that involves the government encouraging us to do a different type of expenditure. And it does involve some redevelopment and redesign around workplaces. So in there and finishing on this, one of the big unknowns for me beyond how do we open up the borders is what does this all mean for property ownership? And the types of properties we need in particular places. So thinking, what do central business districts look like? How do we repurpose some office space? How do we get the balance right with working from home, working in the office, and where we do our consuming? So those are big questions for me that sort of tie in with productivity and how firms will operate over the next year or two.
Great, thank you very much, Chris, and thank you very much for your time today. And also for ASB for supporting this. Just to let the attendees know, we do have more webinars coming up, live webinars coming up in the RSM live webinar series. We have one on the 22nd of October at 10:30 a.m, which is achieving operational efficiency through technology. And that is going to be a good one to attend. I think you can sign up for that pretty much straight away. Once again, thanks, Chris. Thank you for your time. My name's Steve Hayes. I'm from RSM, and I thank you, attendees, for being here on the RSM live webinar series today. And have a great day.
Thanks, Steve. Thanks, everyone, for dialing in.